Inflation is rising around the world, and in Europe we have kind of a different approach. Policymakers have different approach to it. It looks like we are going to have a rate hike in the Eurozone this week. Do you think policymakers are doing the right thing in Europe?
I think the interesting question really is to what extent the ECB is going to raise rates. They have said, they've suggested that this is not the first of a series of hikes. Perhaps all that is needed is just about one or two hikes to prove that rates are not set at an emergency level forever. They've been here at this sort of emergency base level for 2 years now. So perhaps it's appropriate for change's sake to remind everybody that these rates are not frozen in time. I think the key question is to what extent this tension between core inflation in the euro area, which remains very low at around 1%, and these high non-core components that have driven inflation up to 2.6% in the recent flash data, to what extent these tensions resolve themselves. I suspect that there's going to be a moderation, a convergence on both sides. There'll be some trend rise in core inflation, but also it's unlikely that the non-core components can continue to deliver this very high add-on to headline inflation.
And what about how do you think the ECB will reconcile rising inflation and disparity in performance of economies in the region?
Wow, I think the interesting thing there is, everyone thinks of interest rate increases as policy tightening, but of course it is a transfer of income within a closed economy. That's transfer of income from domestic savers. From domestic borrowers to domestic savers, but of course in the euro area it's a transfer from the successful growing to the successful growing economies from the troubled economies. So it of course will add to the tensions that already exist in the euro area.
And what about in the UK? When do you expect the MPC to start raising rates?
Funnily enough, I was quoted in the Sunday Times at the weekend saying that the UK MPC regarded inflation as a window to be looked through, but the ECB regarded it as a wall to be knocked down. Maybe I was taken a little bit out of context. I suspect actually that those differences are perhaps a little bit exaggerated, and I don't think the MPC will lag the ECB by much. We expect them as a house to go by May, and I suspect they'll likely tighten at a similar pace.
So as the strategist, what is your favorite trade then in Europe?
Well, I think the people always say if the herd is moving one way, it's always important to look the other way. And people have pointed, one or two people have pointed out, of course, the risk of a 2008 repeat where inflation in the euro area touched 4%, the ECB tightened, and then of course inflation fell below zero soon after for crisis-related reasons. I think the safest trades to do, because of this incredible volatility in inflation, are perhaps trades of a forward nature, forward starting trades. Now that may seem overly complicated, but one of the things I think is interesting is that if you extend out of, say, 5-year inflation-linked bonds into 10-year inflation-linked bonds in equal cash amounts, so you do a duration extension from the 5-year area to the 10-year, what you're really doing is you're receiving a forward real rate of interest of 2.2%. Now that is, I think, extraordinarily high. It's far higher than average real ECB policy rates since EMU began. And I think that extension along the curve, taking extra duration risk, will pay off in the summer months when we have some sizable index extensions coming, not just in the euro area, but also in the UK and the US.
And in the US today, the Fed chairman, Mr. Bernanke, kind of toughened up his rhetoric a bit. Do you think that, what is your house view about the Fed fund rate?
I think our hike is so far in the future. I can't remember actually when our specific hike call is, but I think the key thing is that the end of quantitative easing in June effectively marks an end of an easy policy, so a relative tightening. And of course, down the pipe we have some aggressive fiscal tightening that needs to be delivered. Quite when and how it remains to be decided. But I think the key thing from the Fed standpoint is that core inflation and to a reasonable extent headline inflation is fairly well behaved in the US. So I think that buys the administration and the Fed a certain amount of time on the fiscal and the monetary front.
But is it right to look at the core inflation? Is the Fed looking at the wrong indicator?
Well, this is a debate that's always run, and of course it's come to the fore again now because of the very high and volatile contribution from the non-core food and energy components. People have often sort of rolled out the cliche that core inflation is okay if you don't drink or drive or eat or heat your home. I guess I would counter that with another cliche, and from performance appraisal goals, where you say you set yourself objectives that you can achieve, and of course this non-core component historically has been highly unpredictable with very little persistence. So in the past that has meant it was perhaps justifiable to look through that, but now I think that the whole non-core core debate almost misspecifies the problem. Really the underlying problem is we've got a bunch of economies that have got low underlying inflation but aren't growing, and we've got a bunch of economies that have high and volatile inflation that are growing very rapidly. So the problem is that the non-growing economies target inflation, and these other countries in Asia largely have inflation targeting as a lesser objective. So I think in that situation where inflation is increasingly a global phenomenon, then central banks need to lean more aggressively against this trend from the non-core components.